In one of our recent videos, we talked about the impressive growth of the Indian aviation industry. Today, we are zooming in on the biggest player in the game, Indigo. This airline company is like the king of the skies right now. Just this week, the company that owns Indigo, Interglobe Aviation Ltd, saw its shares shoot up to an all-time high. In this video, we're going to uncover the reasons behind it. We'll also explore Indigo's journey from a startup to one of India's most influential and profitable brands. So, what's the secret behind Indigo's success? How did they crack the code when others struggle in a very difficult industry? What happened at the recent analyst meet that shot up the company's stock price to an all-time high? Let's dig in and find out. Let's begin. You're watching Informed Investor, and initiated by Equentis. We all saw the recent market volatility, but Indigo stands out as a part of a select group of stocks that have been steadily climbing. In the past 1 month, while the market was moving sideways, Indigo's stock went up by 12%, and just recently, it reached an all-time high. Over the last year, it's given investors a pretty impressive return of just over 94%. So even when things were uncertain in the market, Indigo has managed to keep flying high. Now, before we dive into the specifics of Indigo's success, let's take a step back and look at the broader picture of India's aviation industry and the key players involved. Now, every aspect we cover in this video is important because it will tell you what's behind Indigo's growth. Now, India's aviation market is booming, especially in recent years. India has proudly secured its position as the third largest domestic aviation market worldwide. Now, this growth is also a big deal for the economy. The aviation sector contributes a significant 5% to India's GDP and creates millions of jobs. Now, let's look at some numbers. In 2012, about 58 million people flew domestically in India. Fast forward to fiscal year 23, and that number has more than doubled to 136 million. That's a CAGR growth of 8.9%. Now, meanwhile, international passenger traffic grew at a CAGR of 3.1% during the same period. Now, experts predict that this upward trend will continue, which means more opportunities and growth for the industry in the future. Also, the Indian air travel market remains underpenetrated, providing ample opportunities for existing players to expand operation. Now, the strong demand in India's aviation sector has also made many companies invest heavily, like buying new planes and increasing their operations. Now, Indigo, for example, made a massive move by ordering a 500 aircraft from Airbus. Air India too caused quite a stir by ordering 470 narrow and wide-body jets from both Boeing and Airbus. Now, these bold moves indicate the confidence these companies have in the future of the Indian aviation market and their determination to stay ahead in the game. Now, coming to the key players in the Indian aviation market. When it comes to ruling the Indian skies, Indigo takes the crown. Well, with a market share of 60.1% as of February 2024, they're clearly leading the pack. Now, compared to 5 years ago in fiscal year 19, Indigo has made significant gains. They even hit their highest ever market share of 63.4% in July and have consistently stayed above the 60% mark. However, in recent months, Indigo's market share slipped a bit to 60.1%. On the other hand, the Air India group, which includes Vistara and Air India, saw its market share reach a recent high of 28.8% in February. This also tells you how competitive the Indian aviation industry has become. Despite this, Indigo does remain a dominant force in the skies. And also, let's not forget, being in the airline industry is no walk in the park. It comes with its own set of challenges. We've seen some setbacks in the past, like Kingfisher Airlines in 2012 and the collapse of Jet Airways in 2019, which is still struggling to get back on its feet after 4 years. Now, these ups and downs in the Indian aviation sector shows just how challenging the industry can be. So let's dive into the specific challenges faced by Indian Airlines. Now, take external events, for instance. Think about political unrest or natural disaster or the recent pandemic. When these things happen, it's like a punch in the gut for airlines. Suddenly, operations get disrupted and passengers might not want to fly anymore. The COVID-19 pandemic also hit airlines hard. Travel restrictions and plummeting demand led to huge losses, and some airlines had to make tough decisions like laying off staff or even declaring bankruptcy. Then there's the financial side of things. Running an airline requires tons of money. You've got to invest in planes, maintenance, and all sorts of infrastructure. And let's not forget about operating costs like fuel. Airlines require aviation turbine fuel, which is a derivative of crude oil, and fuel prices are a significant expense for airlines, and any fluctuations in oil prices can lead to significant change in their operating costs. And also, don't get me started on regulations. In places like India, the rules for airlines can be a real headache. Safety regulations, meaning investing in training and equipment, isn't cheap. Plus, there are also these other rules about pricing, scheduling, and where you can fly. Now, having big names like Air India, Indigo, Vistara in the mix makes the aviation market pretty interesting. It means travelers like you and I have lots of choices, which is great for us. But here's the flip side. All this competition can get pretty fierce. Airlines are constantly trying to outdo each other, which often leads to price wars. They're all racing to offer the lowest ticket prices, which sounds good for us travelers, but it's not always great for the airlines themselves. See, when they're slashing prices left and right, it can eat into their profits big time, and that kind of volatility in the market can make things pretty tough for airlines to stay afloat. So yeah, being in the airline business isn't easy. It's a constant juggling act trying to stay afloat amidst all of these challenges. Now, coming to Indigo's success story, it all started back in 2006 when two friends, Rakesh Gangwal and Rahul Bhatia, came together with their different backgrounds to create what would become one of India's most successful airlines. And get this, within just 4 years, the company became profitable. In 2011, it went international, and in 2015, it went public. Currently, it has a massive fleet of over 320 aircraft running more than 1,900 flights a day, connecting over 110 destinations, both domestic and international. Also, it commands a market share of more than 60%. Now, are you wondering how the country's youngest airline quickly became the largest? How did they pull off this incredible growth? Let's talk about those key strategies they employed. First up, affordable fares. In India, where the market is incredibly price sensitive, the cost of flying is a huge deciding factor for most travelers. Now, Indigo stepped into the scene with a game-changing approach, the low-cost model. Now, this wasn't just about being cheap, it was also about being smart. Indigo chose to fly only one type of aircraft, the Airbus A320. This results in greater flexibility by making use of the same crew, from pilots to flight attendants to the ground costs, thereby cutting hiring, training, and upgradation costs. They also have only one economy class, meaning that Indigo does not have to spend time, money, and crew on privileged passengers. They also didn't need to maintain expensive lounges at airports, and this leads to further reduction in costs. So by running a lean operation, they were able to offer rock bottom prices that made air travel accessible to a whole new demographic. The impact, a booming number of air travelers, and a gain in market share for Indigo. Operational reliability is next. You know how frustrating delays can be, right? Well, Indigo made punctuality their hallmark. They've been ranked for their on-time performance and for having low cancellations among other players. They've been ranked for their on-time performance and for having low cancellations among other global players. For passengers, especially those traveling for business, this reliability is priceless. Then there's the aggressive fleet expansion. We spoke to you about the huge market opportunity of India's aviation market. And for any company to capitalize on this opportunity, you need capacity, and Indigo understood this early on. They placed large orders for aircraft, expanding their fleet and enabling them to offer more flights across a growing network of destinations. Now, this helped the airline to increase their market presence. Also, they just didn't grow because the market was growing. They also helped drive that growth by making flying affordable and reliable for millions of new passengers. So when you piece all of these strategies together, it's clear how Indigo not only became India's largest airline, but also reshaped the country's aviation landscape. And the most exciting part, they're still expanding, adding new destinations, and showing no signs of slowing down. It's a classic example of how understanding your market and executing a well-thought-out strategy can lead to success. So let's talk about Indigo's financials. Indigo, being a major player in India's aviation scene, has been racking up impressive revenues. In fiscal year 23, they brought in 54,446 crores. That's over 100% growth compared to the previous year. Plus, they managed to maintain a decent operating profit margin of 12% in fiscal year 23, which is no small feat in an industry known for thin margins. Now let's talk about the pandemic. It hit the airline industry hard with travel restrictions and people being hesitant to fly. On top of that, rising fuel prices and inflation didn't help either. Indigo, like many others, faced losses during this tough time from fiscal year 20 to fiscal year 23. But over the last 5 quarters, they bounced back. They reported a net profit of 2,998 crores in the latest quarter. On the flip side, SpiceJet is still trying to get back on their feet and their financials haven't been as rosy as Indigo's. Now let's dive into how Indigo manages to stay profitable even despite all challenges. Now, besides all the reasons we mentioned above, one significant reason is the sales and leaseback model. Now, this might sound a bit technical, but stick with me because understanding this is key to grasping how Indigo keeps its financial health in the green year after year. Now, imagine you're Indigo. You buy a brand new aircraft, which is a huge capital expenditure. Now, instead of holding onto this expensive asset and bearing all the costs that come with it, you sell the aircraft to a leasing company and lease it back for your own operations. Now, you get the aircraft you need without tying up a massive amount of capital. So why this model rocks for Indigo? First off, this model significantly lightens Indigo's debt load. By selling the aircraft and leasing it back, Indigo isn't burdened by the full price of the plane sitting on its books as a debt. It means Indigo also maintains a healthier balance sheet and financial flexibility, something every airline dreams of. Then there's the cash flow magic. By engaging in sales and leaseback transactions, Indigo converts what would be a fixed asset into liquid cash. Now, the cash covers operating expenses, it fuels expansion by investing in new aircraft, and even allows for shareholder rewards. Now, this model also shields them from the risk associated from owning aircraft, such as depreciation. So Indigo's sales and leaseback strategy allows them to operate with less debt, more cash on hand, and greater operating flexibility. At the Analyst Meet held in Gurgaon on March 22nd, Indigo made some big waves that contributed to its stock hitting an all-time high. Analysts from big names like Citi, Morgan Stanley, Motilal, UBS were all buzzing with excitement about the airline's long-term growth potential despite some short-term challenges. So what got them so excited? Well, Indigo laid out 3 key pillars for driving its growth strategy. They were reassure, develop, and create. Now, reassure is all about keeping customers happy with on-time performance, affordable fares, and a hassle-free service. Develop involves embracing digitalization, and one cool move here is the creation of 6C Sky, which is Indigo's AI conversational direct channel developed in partnership with Microsoft. Now, Create is all about spreading their wings internationally. Indigo is gearing up to expand its international presence by adding new destinations and routes. So what's more, Indigo also highlighted its robust liquidity position and cash deployment strategy. Their free cash flow has soared by 133% in the last 5 quarters, which not only helps them weather any unexpected shocks, but also enables them to invest in building new capabilities. Overall, the analyst meeting painted a picture of a company with a clear vision for the future and solid plans in place to achieve its ambitious growth targets. And investors clearly liked what they heard, driving the stock to new heights. Now, as we discuss Indigo's remarkable growth, it is essential to remember that while growth is fantastic, valuation is equally crucial. If you're interested in delving into the valuation side of things, please let us know in the comments section. Having said that, this is me, Malzana, signing off. Have a lovely Sunday.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.